Hey guys, this is Dawson Discussions, and I'm your host, Nathan L. Dawson Jr. Today's date is December 26, 2021. In this episode, I will be sharing with you what I look for in stocks before I invest in them. This is actually broken down in phases due to time constraints. The first video that I did was qualitative, which is actually what I look for in stocks: the business model, scalability, management, research and development, economic modes, and how the world perceives the company in general besides the numbers. So that was qualitative. This is actually going to be quantitative. Quantitative is actually what I'm going to be talking about is the balance sheets. The balance sheets on what they owe and what they own, the income statements, what are their expenses, and what they actually do with that money, how much debt they have, and how much they can actually have a return on equity, which is actually what I'm actually going to talk about, because I'm actually going to be going by formulas and whatnot. So first video, qualitative, this video, quantitative, and valuation. And last video, or going forward, should be margin of safety and the technical analysis. So stay tuned. Okay, here we go. Quantitative, by the numbers. A profitable company makes more money than it spends. Sure, we expect businesses to be profitable simply because by being a for-profit organization. But many survive for years by securing outside financing or using excess cash. So it's worth checking financial statements to look at profit margins. A great company generates a profit by charging more than enough to cover its costs. Very often, a wide economic moat that I mentioned in my qualitative analysis video helps the business to charge a premium for its products and services, sell a high volume to its customers, control its costs, and operate efficiently, or do a combination of these things. Profit margins vary by industry and industry. Some industries have higher margins than others, so comparing profitability among competitors to identify the best companies in each category is best. But it doesn't really make sense for somebody to compare a profit margin of a company in the utility sector to the real estate sector, because that's kind of disingenuous, but Okay, the first thing that I actually look for is earnings. Earnings are perhaps the single most important and most closely studied number in a company's financial statements. It shows a company's real profitability compared to the analysis estimates, its own historical performance, and the earnings of its competitors and industry peers. It is the profit a company has earned for a period. Earned for a period of time. The earnings figure is listed as net income on the income statement. When investors and analysts speak of a company's earnings, they're talking about the company's net income or the profit. Earnings per share, or abbreviated as EPS, is calculated as a company's profit divided by the outstanding shares of its common stock. The resulting number serves as an indicator of a company's profitability. It is common for a company to report EPS that is adjusted for extraordinary items and potential share dilution. The higher a company's EPS, the more profitable it is considered to be. EPS also indicates how much money a company makes for each share of its stock and is widely used metric for estimating corporate value. An earnings surprise is an unexpected difference between a company's actual earnings per share and analysts' expected earnings per share. Analysts expect company XYZ to report a nickel in earnings per share for the first quarter, and if the company then reports a dime, 10 cents versus 5 cents per share for the quarter, then we could say that there was a positive earnings surprise for company X, Y, and Z. A positive earnings surprise generally means that a company did better than expected over the last quarter. Many times, a positive earnings surprise is followed by a jump in the company's share price as soon as the market opens following the announcement. So essentially, the question that I want to ask myself is the earnings surprise met, or is it positive, as in it exceeded the analyst's expectations? So essentially, one time, I was watching CNBC and it was a company, I forgot the company. So when I was looking at the chart on CNBC, the stock price wasn't really moving, so it was like going sideways. And then when the company had an unexpected the earnings surprise was negative, then the share price just tanked. So Earnings is usually what most investors actually look for whenever they think about when they consider investing in a stock. Also, diluted earnings per share, while diluted EPS is a calculation used to gauge the quality of a company's earnings per share if all convertible securities were exercised. Convertible securities are all outstanding convertible preferred shares, convertible debentures, stock options, and warrants. The diluted EPS will usually be lower than the simple or basic EPS, but in the rare case that there are anti-dilutive securities, it may be higher. In the case of the basic EPS is reported in the financial statements. So what I would want to see is if the diluted EPS is positive and it's increasing annually. Okay, moving on. Levered free cash flow, or LFCF. Levered free cash flow, or LFCF, is the amount of money a company has left over remaining after paying all of its financial obligations. LFCF is the amount of cash a company has after paying its debts. It is a measure of how a company's ability to expand its business and to pay returns to shareholders, dividends, or buybacks via the money generated through operations. It may also be used as an indicator of a company's ability to obtain additional capital through financing. So essentially with the levered free cash flow, I would like for it to be positive. Another thing I look for is decreasing debt, or how much debt that the company has. Durable, competitive companies carry very little to no long-term debt because the company is so darn profitable that even expansions or acquisitions are self-financed. Companies with enough earning power to pay long-term debt in less than 3 or 4 years is a good candidate and are searched for long-term competitive advantages. But these companies are targets for leveraged buyouts, which saddles the business with long-term debt. If all else indicates the company has a moat but has tons of debt, a leveraged buyout may have been created the debt. In these cases, the company's bonds offer the better bet, and that the company's earnings power is focused on paying off the debt and not growth. We are interested in long-term debt for the last 10 years. If the 10 years of operation shows little to no long-term debt, then the company has some kind of strong competitive advantage. So essentially what I would ask myself is the debt being serviced or reduced over time? So essentially what I look for is the debt to equity ratio, or the DE ratio. The debt to equity ratio, or the DE ratio, is used to evaluate a company's financial leverage, and it's calculated by dividing the total liabilities on the balance sheet by its shareholder equity. The DE ratio is an important metric used in corporate finance. It is a measure of the degree to which a company is financing its operations through debt versus wholly owned funds. More specifically, it's reflected the ability of shareholder equity to cover all outstanding debt in the event of a business downturn. So I would like for the debt to equity ratio to be no more than 2.00. Next, I look for profitability. Of course, being a for-profit organization, you have to make a profit. So what I look for is the return on equity, or the ROE, which measures efficiently a company's use of shareholders' equity to generate profits. It is calculated by dividing net income by shareholders' equity. Because shareholder equity is equal to a company's asset minus its debt, ROE is considered the return on net assets. ROE is considered a measure of a corporation's profitability in relation to the shareholders' equity. So what I would like for it to be is to be at least 20%. Another thing I look for is return on assets, or ROA. The term return on assets, or ROA, refers to a financial ratio that indicates how profitable a company is in relation to its total assets. Corporate management, analysts, and investors can use ROA to determine how efficiently a company uses its assets to generate a profit. The metric is commonly expressed as a percentage by using a company's net income and its average assets. A higher ROA means a company is more efficient and productive at managing its balance sheet to generate profits, while a lower ROA indicates there is still room for improvement. Another thing I also look at is the profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or business activity makes money. It is representative what percentage of sales has turned into profits. And of course, bringing up a certain investor from the the earlier video through Quantitative, Philip Arthur Fisher. He wrote this book, Common Stocks and Uncommon Profits. He was an investor. He held on to a Motorola stock since 1955. Then he held on to it to his death, and I think in the early 2000s, 2004, I believe. He wrote, "Does the company have a worthwhile profit margin? The only reason for considering a long-range investment in a company with an abnormally low profit margin is that there may be strong indications that a fundamental change is occurring for reasons than temporarily expanded volume of business. And also, what is the company doing to maintain or improve the profit margins?" Again, bringing another question from qualitative to here, but because profit margins is more quantitative, so I actually borrow qualitative and then put it here in quantitative, in order to ask like what is the company doing in order to maintain or improve it. I think you probably have to read the annual reports or like those reports given out by management. But for a worthwhile profit margin, I look for the gross profit margin. Essentially, the gross profit margin is a metric, analysts use to assess a company's financial health by calculating the amount of money left over from products sales after subtracting the cost of goods sold, or COGS, COGS, sometimes referred to as the gross profit ratio. Gross profit margin is frequently expressed as a percentage of sales. So a company with less than 20% of gross profit margin is not worthy of my investment. It is what it is. A company between 20% but less than 40%, well, 20% to like 39%, is average and it's very highly competitive. So I might tread with caution by going into that investment. But a company with 40 plus percentage in gross profits, there's usually a competitive advantage somewhere in there, and that's actually where I'm actually going to figure out like what is that competitive advantage, and then once I understand it, then I'm probably might consider making that investment. Okay, moving on. Liquidity. Liquidity is the ability of a company to pay off its current debt, which is the near-term obligations, without raising external capital. So essentially what I look for is something what we call working capital. It is a financial measure which calculates whether a company has enough liquid assets to pay its bills that will be due within a year. When a company has excess current assets, that amount can then be used to spend on its day-to-day operations. So essentially working capital is based off a simple formula: current assets minus current liabilities. Now the question is that working capital figure positive? Having positive working capital can be a good sign of the short-term financial health of a company, because it has enough liquid assets remaining to pay off the short-term bills and to internally finance the growth of its business without taking on excess leverage. With a working capital deficit, a company may have to borrow additional funds from the bank or turn to investment bankers in order to raise more money. And the working capital ratio, also known as the current ratio, is current assets divided by current liabilities. Again, the current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations, or those due within 1 year. It tells investors, again, how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. And the working capital ratio question is that ratio greater than 1.00? And I think that's all that I look for quantitatively, at least with these figures. Of course, there's more to it. Again, as I expand my my research, and then once I become a more sophisticated investor, then of course this video is going to be updated. But that's mostly what I look for quantitatively. Now, moving on, valuation. Valuation ratios, essentially these valuation ratios comes from valuation, which is the process of determining what a company is actually worth, the intrinsic value. Valuation ratios put the insight into a context of a company's share price, where they serve as useful tools for evaluating investment potential. Valuation ratios are used to determine the value of a stock or security when compared to a certain measure like profits or enterprise value. So these ratios, also called market value ratios, are measurements of how appropriately shares in a company are valued and what type of return an investor may or may not get. By calculating the market value of a potential by a potential investment, investors can see if the shares are overvalued, undervalued, or at a fair price. It also helps determine how much a potential investor should buy. There are several different valuation ratios calculations that can be done to find the market value of a company, of a stock. Understanding how these ratios work that I'm actually gonna tell you can give you a better evaluation of a company's financial health. So the well-known valuation ratio is the price to earnings ratio, also known as the P4/E. Well, it looks like P4/E, or just the P4/E ratio, or just the P4/E, or just the PE ratio. It's a ratio of a company's share price to the company's earnings per share. The ratio is used for valuing companies and to find out whether they are overvalued or undervalued. As an example, if share A is trading at $24 and the earnings per share for the most recent 12-month period is $3, then share A has a PE ratio of 24 divided by $3 per year, which is 8. Put another way, the investor of the share is investing $8 for every dollar of annual earnings, or if the earnings stay constant, it would take 8 years to recoup the share price. Companies with losses, negative earnings, or no profit have an undefined PE ratio, usually shown as non-applicable or NA on stock screening websites. Sometimes, however, a negative PE ratio may be shown. So essentially with this, I want to compare it to other companies in the industry. The lower PE ratio there is in the industry, the more of a bargain that I'm getting, and then when I buy it, I bought it at a discount. And I love discounts, whether stock discounts or movie discounts, like movie theater discounts, or just like any discount in general. We all love discounts, so we all love bargains, we all love deals, we love discounts. So the lower the PE ratio, the more of a bargain you're getting. And people by nature, we love bargains, we love discounts. Just is what it is with human nature on getting bargains and discounts. Okay, another ratio is the price to earnings growth. The price to earnings growth, or you may know it as the P4/EG ratio, or the P4/EG, or the PEG ratio, is a company's price to earnings ratio divided by its earnings growth over a period of time, typically in the next 1 to 3 years. The PEG ratio adjusts the traditional PE ratio by taking into account the growth rate and earnings per share that is expected in the future. This can help adjust companies that have a high growth rate and a high price to earnings ratio. The PE ratio is higher for a company with a higher growth rate. Thus, using just the PE ratio would make high growth companies appear to be overvalued relative to others. It is assumed that dividing the PE ratio by the earnings growth rate, the resulting ratio is better for comparing companies with different growth rates. So essentially, what I'm asking myself is the PEG ratio less than 1, or is it less than 1.00, or at least as close to 1.00 in the same industry? Next, we have the price to shares ratio, or the PS ratio, P4/S ratio. Essentially, this ratio is a valuation ratio that compares a company's stock to its revenues. It is an indicator of the value that financial markets have placed on each dollar of a company's sales or revenues. The price to sales ratio, or the PS ratio, shows how much investors are willing to pay per dollar of sales for a stock. The PS ratio is calculated by dividing the stock price by the underlying companies per share. Now, what I want to ask myself is the P to S, is the P to S ratio low in its compared to its competitors? A low ratio can imply that the stock is undervalued, while a ratio that is higher than average could indicate that the stock is overly valued. One of the downsides of the PS ratio is that it doesn't take into account whether the company makes any earnings, or whether it will ever make any earnings. Next, we have the price to book ratio, or the P4/B, or the PB ratio. Ratio. So companies that use the price to book ratio, the PB ratio, to compare a firm's market capitalization to its book value. It is calculated by dividing the company's stock price per share by its book value per share, PVPS. An asset's book value is equal to its carrying value on the balance sheet, and companies calculating it netting the asset against its accumulated depreciation. But the book value is also the tangible net asset of a company calculated as its assets minus intangible assets like patents and goodwills, the brand, and trademarks, and liabilities. For the initial outlay of an investment, book value may be net or gross of expenses such as trading costs, sales tax, and service charges. So essentially, when looking for those stocks, is the PB ratio under 1, or is it as low as it is as compared to its competitors? And lastly, we have the price to cash flow ratio, or the P forward slash CF ratio, or the P forward slash CF, or the PCF. Evaluates the price of a company's stock relative to how much cash flow the company generates. It is calculated by dividing the company's market cap by the operating cash flow in the most recent 12 months. It can also be calculated by dividing the price per share stock, or the per share stock price by the per share operating cash flow. PCF ratio is an alternative method to the PE ratio. Many investors prefer to use the PCF metric because it is considered harder to manipulate cash tallies than it would be to massage earning reports under generally accepted accounting principles, which could make the cash-based benchmark a much more reliable indicator. And again, is the price to cash flow low as compared to its competitors? Okay, and that's all that I look for when I try to value a stock by using those ratios. Recapping: the price to earnings ratio, PE ratio, the price to earnings growth ratio, the PEG ratio, the price to book ratio, the PB ratio, the price to sales ratio, the PS ratio, and the price to cash flow ratio, the PCF ratio. Okay, and lastly, we have margin of safety. Margin of safety is the principle of investing in which an investor only purchases securities when their market price is significantly below their intrinsic value. In other words, when the market price of a security is significantly below the estimation of its intrinsic value, the difference is the margin of safety. Because investors may set a margin of safety in accordance with their own risk preferences, buying securities when this difference is present allows a investment to be made with very minimal downside risk. So let's say that you have a stock priced at $1 today, just for easy numbers. It could as likely be valued at 50 cents or $1.50 in the future. You can also recognize that the current valuation of $1 could be off, which means that you would be subjecting yourself to unnecessary risk. You conclude that if you can actually buy a stock at a discount to its intrinsic value, you will limit your losses substantially. Although there was no guarantee that the stock price would increase, the discount provided the margin of safety you will need to ensure that the losses would be very minimal. For example, if you were to determine that the intrinsic value of XYZ stock is $162, which is well below its share price of $192, you might apply a discount of 20% for a target price of $130. In this example, you may feel that company XYZ has a fair value at $192, but you will not consider buying it above its intrinsic value of $162. In order to absolutely limit your downside risk, you set that purchase price at $130. Using this model, you might not be able to purchase XYZ stock anytime in the foreseeable future. However, if the stock price does decline to $130 for reasons other than a collapse of earnings outlook, then you can buy it with confidence. Okay, and I think I do have a little bit more time. Originally, I thought it was actually going to take me a lot longer in order to do this, but in order to actually still be kept within the limit, the time constraint, again, I said qualitative, quantitative evaluation. Now we have margin of safety. Now I'm actually going to throw in a little bit of technical analysis, which is kind of hard for me because you have the charts and everything, but I think I'm more natural to fundamental and the quantitative because it's easier. While technical, you actually have to look at the charts. But over time, when I become a little bit more, again, sophisticated, I'm still growing as a investor. Technical, I'm actually going to move into technical analysis, and then I'm actually going to sum up everything on why would I buy more shares of stock, and actually when I would sell those shares of stock. And of course, I'm actually going to do the overall general pros and cons of owning stocks. So here we go. Oh, and sorry for the nose rub, but yeah, that was a little itchy. Sorry about that. Okay, technical analysis. Essentially, technical analysis is essentially the pricing. So essentially, one of the things that I actually do look at for technical analysis is if it's a leading stock. I try to buy companies that are the leader in the industry or the sector in terms of the price performance. If the stock someone would buy should be seeing overall performance than its peers and should definitely be outperforming over the last 6 months to a year all the major indices, the S&P 500, Dow Jones, NASDAQ, and the New York Stock Exchange Composite. I want to see strength when the major markets are down. So if the S&P 500 have been dropping for a week and the stock that I'm looking for is holding steadily, then that's a very good sign. And I've actually learned that from another investor named William O'Neill. Essentially, William O'Neill, he created the newspaper and also newspaper, then it became digital, Investor Business Daily. He actually created a system for beginning traders called CANSLIM, CANSLIM. And the C stands for current earnings. Current quarterly earnings should be 25% growing because he was a growth investor. A, the annual earnings must be growing annually, 25%. And something new of the company has to come out. A new product that comes out, a new service announced, and then it comes out and then the price shoots up. Or new management hired from within. Because again, you don't want to have management like, say, for instance, McDonald's quit and then he goes to Burger King. Like, for example, or at least the reverse, because having somebody come in from a different rival firm to come in instead of you actually have, again, going back to Philip A. Fisher, like there's no depth. So since they didn't have depth, they actually got somebody experienced. That person quit and now they're working for you. So it's a little investing drama going on, at least like with the business, because the business have drama, and then with drama, and then you get the whole entire idea. And then you have S, which is the supply of shares. Now, with the supply of shares, what this means is essentially it's a gauge of a stock's demand that can be seen in the trading volume of the stock, particularly during price increases. Scarce supply coupled with a strong appetite for a stock create excessive demand and an environment in which the share prices can actually soar. Companies with a durable competitive advantage or a profit-generating machine by nature. So this causes the issue of what to do with those excess money, where the option is to, again, buy back the company-owned shares. This reduces the number of outstanding shares, which increases the remaining shareholders' proportion of the company. Fewer shares also create an increase in earnings per share, just like how I alluded to my previous video, the qualitative. And also, with the 90-day volume, it must be greater than 1 million because it's going to be easier for you to liquidate your shares. L would be leader or laggard. How is your stock leading or is it lagging? I is the institutional ownership. Again, 30%. And again, institutional management. You want to beat them into actually getting that stock. So you want to have them own 30% because it's on the radar of what they're actually going to do. Because they have huge buying power, and then when they go in, your stock price is going to go up. And then if you have stock, and then if they move out, then the stock price is actually going to come down. And then M would be market direction. So that you actually want to, according to William O'Neill, you actually want to be buying in a bull market in order to, keep your gains. I think that's what he said in his book, How to Make Money in Stocks. Okay, and this is when would I consider buying or holding on to more shares? Well, probably, yeah. So buying, which means I want to buy some more shares. Hold, which means I'm not really going to buy as much, or I'm just going to not buy, but I'm not really going to sell. But let me focus on why would I buy more shares. Okay, and here you go. So I would consider buying more shares, decreased competition, wide economic moat identified. It's in a growing industry. It's the leader in the industry. It have a very large market share, strong revenue growth, strong sales growth, strong earnings growth. It beat the earnings surprise that's positive. Strong cash flows, positive free lever cash flow. What I mean, the profit margin is increasing. Return on equity is high. Return on assets is high. Decreasing debt or there's no debt. Positive legislation affects the business model. You're making investments into research and development. A new product is introduced, a new service is introduced, or a new management is hired from inside a company instead of a outside company. They're increasing its annual dividends if it's applicable to dividend payers, because not all companies pay dividends. Usually those small companies don't really pay dividends because they have to reinvest their retained earnings to actually grow the company. Also, stock buybacks. The company is buying back its stocks. C-suite, they're buying more shares. Again, institutional investors, mutual funds, pension funds, hedge funds, insurance companies, banks, credit unions, venture capital firms are buying more shares. Costs are decreasing to create the product or service, and they have lots of cash on hand. Lots of cash on hand. And those will be the reasons why I would buy more shares or hold. Well, hold is kind of neutral, but those are the reasons why I would buy more shares. Okay, moving on to reasons why I would sell. Increased competition, lost their economic moat. They're losing market share. It's in a declining industry. They're no longer the leader in the industry. They have an adverse change in management, as in a drastic change. Of course, the CEO probably might want to step down, but if the CEO gone, the CFO is gone, the chief operating officer, COO is gone, all at once, something isn't right about that. Outsiders of the company are in management. So the new CEO was not hired from in the company, but rather an outsider. Like I said, the CEO of McDonald's quit, and then somebody else outside, like maybe the Wendy's CEO, comes in and then takes charge. There's a saturation of the market. If the business is dependent on a few products and there is a stagnation of demand across all possible markets. Earnings is slowing down, sales is slowing down, the profit margin is decreasing. The business is in legal trouble. Adverse legislation affects the business model. New obsolescence, like Netflix made Blockbuster obsolete. It's increasing its leverage. It's cash flow negative. The return on equity is low or lowering. Return on assets is lowering or is low. Costs are rapidly increasing in order to make their product or service. You found a better investment opportunity. You reach your price target during a crazy bull market or due to your personal standards. You're reallocating your portfolio. You're trying to tax loss harvest, as in the selling of your securities at a loss in order to offset a capital gains tax liability. A need for liquidity because you just need the money. I know with that, prefer for you to have, their 3 to 6 months worth of expenses and all your bills paid on time, because, you actually want to, plant the seed in your investment and then watch it grow. It's an analogy. Anyway, moving on. Institutions are selling it because they drive the prices down. The dividend is stagnating, or they stop their dividend altogether. And those are the reasons why I would sell a stock. Again, I'm a young investor, so I don't know everything about investments, but I'm just, learning through, books, videos on YouTube and whatnot. But again, I'm still learning, still young, still new to investing. So, yeah. Okay, what are the pros of owning stocks, or why do people invest in stocks, or what do I like about the stock market? Well, they're saying that the stock market average annually returns of 10 to 12% a year. So inflation on average is 3.22%. So this means that if you're getting a 10% return and inflation is 3.22% because of inflation, then you're still earning 6.78% or almost 7% on your money. If you're getting a 12% return and 3.22% is taken away due to inflation, then you're still earning an 8.78% or almost 9% of your money. Of course, that is a great return. So if you were to start off with $1,400 and you put away $10 a day or $310 a month for 50 years, assuming a 7% interest, you would have $1.5 million. If you instead have your contribution set to $620, which is double your monthly contribution for the example, with the same factor, you would have $3.1 million. And if you have your contribution set at $1,000 a month, you would have $5 million. That is the power of compound interest. Compound interest is interest earned on and added to the original investment principal, and thereafter also earns interest. In other words, compound interest is when your money makes money on itself. Keep in mind that compound interest also works for your favor through investing in the stock market, and also against you when you take on excessive consumer debt. So when you invest or put your money in, or when you compound your money like that, it grows your wealth, and thus money is working for you. The key to building wealth in the stock market and achieving your financial goals in general is to manage just the direction of interest in your favor through compound interest. The way to do that is to know your financial responsibilities, manage your money, and protect your wealth. Which is kind of like why I made that small side remark on don't just take your money out of the stock market because you have an emergency. That's why we refer 3 to 6 months of savings, and then you just keep your money in the stock market, and then you just let it grow. I'm just trying to look after you guys. Another reason why I like the stock market is my favorite way to make money: dividends. Many companies usually distribute a portion of its earnings to its shareholders. If you're an investor looking for a residual income source, a dividend growth strategy can actually pay off very handsomely. But then again, taxes. That's actually one of the main criticisms of dividends, because taxes. But then again, if you can actually reduce your ordinary income to like 0%, then taxes really shouldn't be much of a problem. Another reason why it is a relatively liquid investment. Comparing stocks to other investments like real estate, and if you don't know how to sell them, gold and silver, stocks are very quite liquid. That means you can easily sell your stock to access the underlying dollar value if you need to. While many other investments can have you wait for days, weeks, months, years, maybe even decades, for the most extreme cases, stocks can actually be sold within a matter of seconds or a matter of minutes. They're very flexible. They come in many forms. There are stocks that pay out dividends, stocks that help save the environment, stocks that help rebuild infrastructure, and etc. There are literally so many different types of stocks. There's just bound subject to suit your fancy. Whether you're just trying to make the most money you can or just put your money towards a good cause, those investments can offer you a wide array of options. And it's very easy to start. There's so many online brokerages that allow you to buy and sell any stock: Fidelity, Charles Schwab, Robinhood, Webull, M1 Finance, Public, Stash, and whatnot. And there's a whole lot of brokerages out there. And also, YouTube, like this video, where this video is going to be at, walks you through step by step on how to invest using which account. And there are even videos out there walking you through like what stocks to buy based on your preference, and they probably edit the video much better than I can. But of course, later on, I'm actually going to make videos based on that quality. And there's also a low barrier to entry, like you just need like your social security number to open up an account and then start funding money into your account. Okay, what are the cons of owning stock? While you have market volatility, especially in today's market environment, we're seeing incredible swings every trading day. Stocks hitting all-time highs, stocks hitting the all-time lows. This is something that you have to be prepared for as an investor. If you're investing in the short term, then these fluctuations can be quite unnerving. However, if you are in it for the long haul, then you should know that your investments will increase in value in no time. Plus, you are not really in a rush to sell. There are plenty of corrections and crashes along the way, and you just need the fortitude not to freak out when it happens and then panic sell whenever it do happen. And of course, many investors say they focus on the quality of the company more than they focus on the price itself. That's why I don't really talk about price or technical action, because technical action is price. Of course, technical action is very important, so I know like what price I would actually look at. But I prefer fundamentals because I actually want to know the business. Because if you know a really good business, and then if the price falls down, even though they have very, very good fundamentals, you can actually buy that at a bargain or a discount. Again, humans, we love discounts. Just like how Philip Arthur Fisher said, the stock market is filled with a whole lot of people that know the price of everything, but they know the value of nothing, or some to that effect. So if the quality is up, but the price is down, you have a discount. And humans by nature love discounts. We love deals. We love discounts. We love discounts. And we love saving our money, couponing and whatnot. Again, which leads to market crashes. Again, don't panic. Crashes are just inevitable, especially if you're investing for the long term. Previous crashes have shown that you will earn your investment back in just a couple of years if you weather out that storm. Just like another a favorite investor of mine is John C. Bogle. He created the index fund. And then with the index fund, I'm actually going to create a video about index funds, mutual funds, and exchange traded funds. He created Vanguard, which is one of the world's most respected and well-established investment firms. So he said, just buy right and hold tight. Again, I'm actually going to do a video on him a little bit later when I talk about mutual funds in the future. So with that said, you try not to sell your investments, especially when they're less than what you bought them for. Focus on the business quality itself, high sales, investments into research and development, increasing their market share. They're the leader, and all those qualitative factors, and they're not taking on a whole lot of debt. You'll be fine. The price really don't matter too much. I mean, yeah, people don't want to cut their losses because they say don't lose money, and then don't lose money for rule number 2 for Warren Buffett. But I focus more on the fundamentals and the quality of the stock, not really the price. Yes, the price is important, but I mostly look at the fundamentals, like the qualitative and then the quantitative. And of course, capital gain taxes can be high. If you're a frequent trader, not really much of a buy and holder. If you buy $1,000 worth of stock, then you sold it 8 months later at $3,000, making a profit of $2,000. And if you're in that 24% tax bracket, then you will probably pay that $480 in tax for a net gain of $1,520. But if you hold out for a little bit longer, you can actually claim long-term capital gains status, and then now your stock will be worth $3,500, leaving you with a gain of $2,500. So your tax bill on a long-term rate is at 50%, which is going to be $225. So you actually made a much more significant profit if you just hold on for a little bit longer. Also, number 4, there's no guaranteed return. Although historically the market provide a supposed 10 to 12%, but then again a little bit lower, 7 to 9% because of inflation, it's not always guaranteed, especially for short-term markets. The best way to ensure you get the higher percentage is just to keep your money invested for as long as you can. And lastly, it takes knowledge and time to analyze a stock. Well, just like with the whole basis of this video, I actually broke down what do I actually look for before I actually invest in an individual stock. Not to say that having to analyze a stock is a very bad thing. This actually would separate successful stock investors from the rest anyway who don't do their research, but it simply requires much more time and effort to pick the right stock as compared to them picking the right savings plan for your money. And there you have it. In order to conclude this 2-part video series, this is actually what I actually look for investing in stocks. So to wrap up, qualitative, the soft metrics, business model, scalability, market share, competitive advantage, how consumers perceive the brand, the products, the quality of the products, and management. And then you have quantitative, the balance sheets, how they handle the money, margin of safety to make sure that I'm not paying too much for a stock. In case if I'm wrong, then I lose a whole lot of money. But if I'm right, then I don't lose a whole lot of money, where I still preserve my gains. Technical action, I prefer to have the leading stock, which is if the stock index is going down, then the stock is going up, then the stock itself is good. When I will buy more shares, when I would sell those shares, and the pros and cons. Okay. And lastly, this is Nathan L. Dawson Jr. This is Dawson Discussions, and I will see you in the next video. Next video is actually going to be on mutual funds, which is also going to be, actually I prefer mutual funds over picking individual stocks, but over time when I become a little more sophisticated, then I'll have a concentrated stock portfolio someday. So again, this is Nathan L. Dawson Jr. This is Dawson Discussions, and I'll see you in the next video. Take care and have a nice day.